as we mentioned, we just talked about we just posted on Thursday the earnings season hat trick for locking in gains. You have a stock, it's moved up in price, or even if it's stagnating, you're coming up to earnings. Well, there's a way that you can structure it using the married put and the concepts of the radioactive trading technique to protect the position or lock in some of the unrealized profit, generate income, and leave the upside open going into earnings. So it's a great play to use for an uncertain market and uncertain earnings on a stock that you already own. So we discussed this, and it had some responses. And Anthony's response was, when is the optimum time to manage or roll, quote unquote, the hat trick, or the optimum time to adjust it? Okay, well, let's take a look. If I had bought Darling on April 11th at 73.85. Stock dropped today to 79.66. We just saw that, but this is still a good, almost 8% unrealized profit. Earnings for DAR are coming out on May 4th. This is a good opportunity if you own the stock and have an unrealized gain in it to do the hat trick for locking in gains. What are my steps? Well, first I'm going to go into the Married Put tab, and I'm going to click on Insurance. I'm going to go to DAR, and my cost basis for share was 73.85. And I think I'm going to look out to June or July. Let's see if there's a July series here. Oh, no. Okay, so I got to stick with June, I guess. I thought there was a series there, but let's go ahead and take a look at June. Okay, I'm sorry about that, folks. Something's odd here. It had results earlier. I'm not sure why it's not showing up now. I apologize for that. Let me try. Did I put something in wrong? No, it's 73.85 was the price, right? I got June. Let me just go all expirations. Maybe that's causing a handicap. There we go. That's better. All right, so the May's, July. That's what I wanted. I want to see the July series. Great. Sorry about that, folks. Let's go ahead and put in July. Fantastic. So we have an unrealized almost 8% gain in the stock. Now that the stock has moved up slightly, we could buy these puts cheaper than we did before. And see here, the stock is 79.85. This is interesting. The 85 put gives me a locked-in profit or bulletproof status of 2.1%. It's 84 days out. If I really want to stay in DAR long-term, I'd probably be going the standard radioactive length discussed in the blueprint of at least 150, maybe 180 days out in time or more. But we've got this profit where we can potentially bulletproof the position here with buying the 85 put. Let's see what that would look like. So we have the stock at 73.85. The 85 put for July is going to cost us $9.40. So that's going to put my cost basis up to $83.25. But I'm guaranteed to get at least 85 back no matter what the stock does at earnings. So we've got a locked-in profit of 2.1%. Now, to complete the hat trick, I want to reward myself. Earnings are coming out May 4th, so we're going to stick with May expiration. And I'm going to, not great, but we're going to sell that 85 call for around 195 or so. So that goal 1 was to lock in the gains. We did that. Goal 2, let's put this at 195. Generate income to reward ourselves for picking the right stock going into earnings. That's great. But what does that do? Well, now I've got a guaranteed profit of 4.6%, even in the worst case scenario. A max profit of 11.2%, but the gain is capped. I'm not sure if I want to do that. I want to leave the upside open in case there's a big earnings surprise. So to complete the hat trick, leave the upside open, try to retain most of the premium we got from the sold call. Yeah, I'm going to go, I'm going to go with the 95. I'm going to go with a 10-point spread on this one to keep most of that 195 premium. And that's similar to the graph that we had in the presentation. Oh, I'm sorry, I didn't want to do it that way. My apologies. Here we go. Let's use that scrubber correctly. There we go. I still have unlimited upside. Now, I'm not expecting DAR to go up to 100, 105, 110, but I've had 1 or 2 earnings blowouts on a married put before. Goose is one I remembered where it jumped up from about $42 to $68 at earnings when we were in the married put position. And there was another big one I had. I can't remember if it was the other direction. It was a terrible 33% decline. I can't remember if it was Penn or if it was RPM. Yes, I did a radioactive profit machine, and RPM on stock, RPM International. In any case, this is what we're looking at here. We left the upside open, awarded ourselves some premium, a guaranteed profit of 4% if the earnings are disastrous, and that's in the absolute worst case scenario. Okay, but now Tony's question was, when is the best time to unwind or unroll or roll this position? Now, I set this up for an earnings play, so naturally I'm going to wait till after earnings. And usually, after a big move, whether it's market related, whether it's stock related, or whether it's earnings related, depending on the structure I'm in, but this structure in particular, which is a no risk position, a completely bulletproof position, I'm going to wait maybe a day or two after earnings because maybe there was a possibility of an overreaction. Maybe there's a possibility of something else happening in that scenario. But what are the scenarios? Okay, scenario number one. Stock doesn't do much. It has one of those meh earnings. Good report, just a little bit above expectations, a little bit below. Reasonable outlook for the next quarter. It didn't really change too much. The stock moves up 3% or the stock moves down 2%. It stays right in this, let's say, 82-ish to 74-ish range. Okay, no problem. Number one, no real move. I do nothing. Okay, what's going to happen? This income method number 6, the second goal and third goal that we did is income method number 6 in the blueprint. Let me clear that up. That is a terrible drawing. It's a bear call credit spread, but done in the context of the married put position. It just looks like a covered call with an extra long call. That's income method number 6 in the blueprint. You want to make sure that you do the proper structure because it can get you into trouble if you do it wrong. So Tony, small move, stays below the strike prices of the calls. I'm going to do nothing. I'm going to let, most likely, those two calls expire worthless on May 20th, the full expiration, so I get that full net credit that we took in, the $1.90 minus the 60 cents or so that we paid for that 95 call. Let it expire, keep the premium, and then reevaluate what my next income method is going to be. So small move is do nothing. Just stays in this range below the short call strike price, doesn't drop, say, below 75, or maybe even, below 75. I'm still in a good wheelhouse area here. Just going to let it sit there, take my full profit on this income method 6, and reevaluate at May 23rd after May 20th expiration. Situation number 2. We have a large movement up, exceeds our expectation. Let's put this at 2, and say it goes up to 105. What do I have? I have a put that's declining in price because the stock, it was an 85 put, now the stock's 20 points above it, so that's losing value. I had an obligation to deliver shares of stock at 85. It's kind of a covered call, but I also have the right to buy it at 95. I'm losing 10 points here, but I've gained 25 points plus from where the stock was to where it is now at 105. So, large gap, what are my options? Well, I can let the stock be assigned and then let that 95 call be exercised to get back in. Okay, so we'll let assign and exercise. I'm back into the position at 95 in this case, but I took the profit from the previous position. Had to deliver shares of stock at 85, still a profitable position. So I'm back into the married put, and I'll let it be assigned / exercised. And then I'll look to do income method number 4. I'll look to manage that put now that the stock is trading higher and I'm back into the stock. Or in this scenario, what I could do is liquidate the spread, liquidate the income method number 6. I'll have to pay the 10 points here to close it, between the strike prices, but that's okay because I've made 25 on the stock. And then I might continue a new income method number 6 for, say, June or further out in time with maybe a 110, 115. But liquidate and evaluate other income method, including maybe adjusting the put, as I had mentioned before, and using maybe an income method number 1 or another income method based on your expectations. You're still positive, even though you have to close out this bear call credit spread because you have more unrealized gain in the stock than you had to pay to close the bear call position. Okay, so that's for a large movement up. For a large movement down, What happens? Well, no worries. I can probably buy that spread back cheap. These two calls are going to be a much lower price. I can close that out for almost nothing. And then I can evaluate just what I would do with a standard married put this down. I'm holding the 85 put. Do I want to do a management, move the put down, move it closer in time? So we'll take a look at that. We'll let the calls expire or buy them back cheaply and then evaluate what we want to do with the remainder of the position. If my sentiment is completely changed at this point, the stock, let's say, falls down to 65. It's terrible earnings. Not even that, Tony. The outlook for the next quarter or the next year, they lower the guidance and lower it a lot. And so the stock just crashes down to 66, 65, 64. At this point, my bullish sentiment on the stock has probably changed. I can just liquidate the whole thing, and I'm still making a profit of about 4%, even with roughly a 14, 15% decline on an $80 stock. I'll take that every day of the week. You know that. So let the calls expire and evaluate other adjustments or liquidate and move on. You've got the gain in place. You had it structured perfectly. This is better than taking any kind of loss that you would have seen, even a 4, 5, or 6% loss on a standard married put. You're taking a gain of 4% with that massive decline. And what would seem the trickier one, which is actually pretty easy, is in the scenario where the earnings come up. Let's say the stock goes to 90. That's a good earnings. It moves up 10 points. That's still a great move. But it goes between the strike prices. It moves above $85. What did I do? I sold the call here for goal number 2 to get income to reward myself. We sold the 85 call. That does obligate me to deliver my shares of stock at 85. So it's between 85 and 95. I'm sorry, I should say between 85 and 95. What might I do in that scenario, Tony? Do the same thing that you would in a blueprint. Treat this just as an income method number 1. You sold a call against it. This call is going worthless, or it might even expire worthless if you hold it that long. You're going to evaluate exactly what you do with an income method number 1, following the rules in the blueprint that's now in the money. You could apply income method number 2, or you could even maybe look to do that income method number 7 trick as well, depending on your outlook for the stock. So that's it. Okay. That's the adjustments that we're talking about. So number 1, a small thing is do nothing. I kind of did what you want. You get the full profit on the income method number 6, and you still have got the married put in place. You've still got a bulletproof position. You're looking great. You can continue to do income methods against it. Unexpected gap move up. You can let it be assigned, then evaluate adjusting the put, or you can liquidate the spread, not the whole position, liquidate the spread, and then evaluate other income methods to continue to trade. Or look at this point. I mean, if it's up here and you're in this profit range and you've hit your targets, and that movement, you could just liquidate the whole thing. Just unwind it. Sell to close the put, sell to close the stock, buy to close your 85 call that you sold, sell to close the 95 call that you sold. Unwind all 4 legs. You're out of the position with a strong profit. Okay, but likely if that exceeded it, that means the company's doing really well. They're exceeding expectations. I might want to continue this as a married put. So I either let it get assigned at 85 and then let my 95 call be exercised to buy back into the stock, continue the married put with that new cost basis, evaluate the other ones. Large gap down, let the income method number 6 expire and evaluate other positions. Or if my sentiment has changed, I'm liquidating out of the whole thing, Tony. And if it's between the strike prices of that income method number 6 that you have there, treat it just like you would an income method number 1, following the rules in the blueprint. And yes, David, I was getting to that. For those of you that don't know what I'm talking about, what we're talking about here is the married put structure. This is something that can be used in the married put structure, this hat trick for locking in gains, where we use the insurance tool to lock in an unrealized gain on the position. But most of the married puts are opened with some risk in place. We use the search tool and power options to identify positions that match the structure we look for in the blueprint. Risks of 7%, 6% here. I'm in AIG, which I think was on page 2. Oh, it probably dropped out with today's movements. Ernie's in Blackstone, and the other one, I've got 3 open right now. I'm sorry, I've got 2 open right now. He's got 2 open right now as well, and I'll probably be once I see what happens next week. But in any case, what am I talking about with all of this? David, the structure of the married put that we prefer and the 12 different income methods that we use against this low risk position where we buy stock and we buy a put, leaves the upside open, we control risk to the downside. It's sort of the opposite of a covered call, where you have a capped gain to the upside and still carry all the risk of owning the stock. minus the 3 or 4% that we did. And the 12 different income methods we use, everything from generating income to adjusting the put. The put is actually not a wasting asset. It's a second working asset that we can manipulate 3 or 4 different ways. And what we're looking to do is lower that initial at risk by getting income on the position and the cost basis to where you could eventually have a position that, as you just saw, has no risk to the downside, which means a bulletproof trade. We can still generate income against it. That's all discussed in the blueprint, the full proper structure of the initial married put, the ways to lower that initial at risk with the proper income methods. There's 12 different income methods, some that include manipulating the put. Others are using spread positions nested inside the married put trade and other adjustments as well. There's also full chapters on when to exit a married put position if goals have been hit. Each chapter in the blueprint, each income method chapter covers how and when to use that adjustment against the married put structure properly, how not to use it. The SIGA model, which is our decision-making process of when you would look to use a particular income method over the other. There's a full, of course, appendix there showing trade examples, sample trades, and much more. So that is the blueprint. It's an all-electronic copy. So if you purchase the blueprint, we'll go ahead and send you a link to our educational portal, learn.poweropt.com, where you'll have access to the full written text of the blueprints and the radioactive trading techniques. You can find it, of course, more information on there. Under Power Options, go to the store, and you see here there's the blueprint and the home study kit. It's $349, but you also get, if you purchase the blueprint, you also get a free month of Power Options as well. And you also get some other bonuses that are thrown in, which you can see about there. Let's just take a look here. More information about the blueprint. And David, you can view the full table of contents right here as well. So you can just look at it there in the store, the structure that we use for the married put, the 12 different income methods, and much more. And of course, David, that works as an advertisement and a plug for our products. So you said, thank you for explaining. Well, you're welcome. It works for me too. For a product placement, I should say, for the blueprint. And that's what will be discussed there with the hat trick for locking in gains that we posted on Thursday. The review here for Tony of when we might look to roll out or unwind the hat trick for locking in gains. Again, you can find the blueprint there on the Power Options store, or of course, you go to Radioactive Trading. Let me sign out here. .com, and you go into products, you'll see the blueprint there as well. So the different descriptions there for the blueprint. Both stores are available. It's $349, but you do get different bonuses there. Free month of Power Options, a discounted first month of Fusion, and we'll send you one of the Mastery Series CDs, the 6 videos that comprise the blueprint and the 6 Mastery Series videos. That's the home study kit, which is $5.99. But you purchase the blueprint, we'll give you the first of the Mastery Series videos, the Foundations of Radioactive Trading, for free, and you'll be able to watch that on the educational portal there as well. So yeah, that's the blueprint there. And you can check it right there at the store. You can even click on it here. I'm sorry, David, right from the married put position in that case. And David says, so it's like a good discount if you're already a subscriber like I am. Yes, you get the discounted subscription rate for 1 full month of subscription cost if you're already a Power Option subscriber if you pick up the blueprint. Absolutely, David.